Alright guys, let's quickly take a look then at tonight's labour market data from New Zealand coming up at 11:45 UK time. Now this Q2 labour report, it's said to be an important one because it comes just ahead of the RBNZ policy decision next week. And we know the markets will be watching this report closely to give us some, well-needed insights into the labour market in New Zealand, since we only get this data on a quarterly basis, right? We don't get it monthly like we get from the US or even even Australia. We only get this data quarterly, and it could shift market expectations for next week's meeting, depending, of course, on the size of the deviations that we get. So let's quickly start with what markets are expecting from tomorrow. Let's start with job growth quarter over quarter. There, it's expected to remain in contractionary territory at negative 0.2%, basically indicating ongoing challenges, if you will, in the labor market. The unemployment rate, more importantly, is anticipated to rise to 4.7 from the prior 4.3. That's pretty big, right? That reflects the broader economic slowdown. If we get that, that'll reflect the broader economic slowdown that so many market participants have been warning about in the recent weeks for New Zealand. In terms of the labor cost index year over year, that is forecasted to ease quite a lot, down from 3.8 all the way to 3.5, suggesting a broad reduction in wage pressures, and obviously that should be good news for the RBNZ on the inflation side of things. Now, in terms of market pricing on the money market side, coming into the data, we can see that the markets are currently pricing in a 66% chance of a hold next week from the bank, with a 34% chance of a cut. So, for interest's sake, the NZIER, the shadow board, they're also siding with the market's broad expectations for a hold next week. But the caveat to that is that none of them had this labor data, right? They had their own data, and we'll look at some of that in a second. But if this data comes in bad enough, then obviously that could change some of those assumptions. So at 66.34, we are close enough to a cut, right, and far away from a hold to potentially change things here in the short term, going into next week's meeting. Now, the context coming into this print is important. I mean, the recent data, let me just show you guys this. Apologies for the runny nose as well, guys, and the overall flu voice here. It seems like the little guy has caught something, and for those of you who's got kids, you'll know that once one of them has it, it's just a matter of time for the whole household to go through it. So I do apologize for that. Let me just quickly find that data. Here we go. So the recent data that we got from the NZIER, I mean, this has highlighted a deteriorating economic landscape, right? We've got rising unemployment. We've got very much weakened business conditions. I mean, what we've seen is that high interest rates basically continue to weigh heavily on demand. You had a net 35% of businesses basically expecting economic conditions to worsen in the coming months. That was up from the prior readings. You have a lower number of firms that is expected to raise prices at just 23%. And that was the lowest number, if I recall correctly, going back to the last 3 years. So you're seeing downside in business activity. You're seeing downside in input prices, which is obviously good for inflation, but it is showing you that there's slowdown in growth, there's slowdown in inflation. And in terms of the labor market, the report has shown significant strain. There were more firms cutting headcount in the prior quarter. I think it was 25% of firms saying that they had to cut jobs. So it's pretty bleak. These indicators align with expectations of basically a soft labor market, falling inflation, and falling economic activity. So it's reinforcing the narrative of a very much a struggling economy that's in need of support from the RBNZ. And that obviously makes sense of why the bank took that slightly more dovish turn in their language with that July decision that we had. So it seems like all paths seems pretty bleak right now, which means a very ugly jobs report tonight could see the markets flipping their expectations of a hold towards a higher probability of a cut. Now, the only challenge with that from a tradability point of view is that market positioning is already, take a look at this chart. This chart has shown an immense amount of downside for the Kiwi dollar already, right? And if we quickly bring up the positioning information, just give me a second to bring up CFTC data here. If If we take a look at this chart that we looked at yesterday, let me just quickly find that. Here we go. Now we are so close to being in stretch short territory. And remember, looking at the currency index, that is where the CFTC data was updated. So it's very likely that we are already stretched short from both a positioning point of view, and obviously just looking at the price action, we've seen an immense amount of bad news priced into this currency in a very short space of time, right? So that complicates the way that we trade the event. So, for this reason, even though there could be some downside in the Kiwi dollar if we get a miss, especially if it's a big miss, I'm just not sure that I will be up for shorting the Kiwi dollar if we do get that miss. Please understand, I'm not saying the Kiwi can't go down on a miss, right? Our baseline expectation is that bad data should see the Kiwi push lower, especially if it's bad enough to flip expectations from a hold to a cut. But since the Kiwi is trading literally at the lows at the index level, and with so much risk already priced in, if you're looking at volatility, which is trading at very expensive levels, if you take a look at the amount of risk that's priced into risk reversals, I don't really like trying to chase the Kiwi short on a miss. Look, at the end of the day, we are all responsible for our own capital. So if you have conviction to short it on a miss, that's 100% fine. But for me, I'll be staying patient with it on a miss. I would prefer to trade it as a clear beat, not just because of positioning and how much bad news has been priced in, or because of volatility or risk that's priced in. All of those things matter, of course, but also because the markets are already quite skewed towards a weak print. Looking at just the baseline expectations, and we'll look at the forecast distribution in a second as well. For me, it just means that a solid print, a solid beat, it'll be so far outside the market's expectations. I think that'll just offer us a much clearer, bigger surprise to potentially trade. So let's look at the numbers. I have the minimum and maximum thresholds here, but let's look at this from a trade plan point of view and look at those numbers in a bit more detail. So let's start with the unemployment rate. We can see here that the minimum expectation for the unemployment rate is 4.4, maximum is 4.9. Now, keep in mind, the higher that is, of course, the worse it is, the lower it is, the better it is. So in terms of a miss here, I'm looking for a number that cracks above 4.9%. Why am I looking for that number? Well, firstly, that's going to be above the max, right? But if you take a look at the chart from a time series point of view, let me just quickly find the unemployment rate here. Here we go. You can see that anything above 4.3 is already going to be a new cycle high, and referring to COVID being the start of a new one. Obviously, if we can get up to 5%, that'll not just be above the market's maximum expectation of 4.9, but we will be getting very close to those COVID peaks. That'll be quite a surprise. The reason why I think we need a more punchy number as a miss there, like 5%, is firstly, the maximum is sitting at 4.9, but the market's already expecting a huge increase in the unemployment rate from 4.3 to 4.7. So going from 4.3 to like 4.8 or 4.9, that'll surprise, but you're looking for a number that's really, really big, right? And that also puts you at that psychological level. Going from a 4 handle up to a 5 handle in unemployment, that'll be very dovish. Now, what about a hawkish outcome? Look, for a hawkish outcome, I'm looking for a number 4.3 or lower. 4.3 will be in line with the prior, right, which came in at 4.3, and we will also be below the market's minimum expectation. Now, the reason why I'm happy with this not being below the prior and just in line with the prior is take a look at the skew. The markets are already so skewed towards this as a, let's quickly go to the unemployment. Take a look at this. The market's already firmly skewed towards a higher number here. At 4.4, which is the minimum, you've got everybody above there. You've got the highest one at 4.9. So if we come in at 4.3, even though it's in line with prior, that'll be a big surprise for the markets, especially since consensus is looking for a big jump in the unemployment rate. So I think that'll be fine in terms of a beat. Also, it'll be below the RBNZ's forecast, which was much higher at 4.6% for the quarterly number. Now, in terms of job growth, Expectations for this one is to remain in contraction at negative 0.2. In terms of a miss, I'll be looking for a number that's negative 0.4 or lower. That'll be below the prior, which is obviously negative 0.2. It'll be the outlier print. Now, quickly take a look at this. Outlier, but not the... Where is that? Here we go. It'll be the outlier, but it's not the minimum. The minimum is just, it's way too far away. It's a clear outlier, right? If you've got your consensus around negative 0.2, you've got 0.3, 0.4, but then all the way to 0.8, that's just, I don't think we need to see it below this to get a surprise. Don't get me wrong, if we do print below that, that'll be like really dovish, but I think at 0.4 or lower, you're already surprising the vast majority of analysts polled for this, right? 13 out of 15 will be surprised by that number. So that, I think, will be good enough in terms of a miss. In terms of a beat, I'll be looking for 0.2. Why? It'll put us back above 0, so out of contraction territory in terms of job growth, which should be, firstly, a positive. It's at the max, so we're not above the max. The max is sitting at 0.2. But if you quickly take a look at this, where's that forecast distribution? Here we go. If you take a look at the skew of the forecast distribution, right, there's literally only 3 analysts among these 15 that expect a positive number for job growth. So anything above 0 will already surprise 13 or 12 of them, which I think is good enough, right? I think especially given how much bad news is priced in, firstly, a positive number will be fine, will be great, back above 0. We're not above the max, but I don't think we need that. We'll basically be at the outlier, at the maximum already. In terms of labor cost quarter over quarter, expectations there is for a flat print of 0.8. So I'll be looking, obviously, in terms of a dovish print, we'll be looking for a miss. 0.6, now that's in line with the minimum, but more importantly, it's below the prior. So it's already going to be a miss on both fronts. And if you take a look at the historical data here for that number, let's just quickly find it. Here we go. If we print below 0.6, it means we take out these 2021 Q3 and Q4 0.7 level, which will give us the lowest print going back all the way to May 2021. So that'll be a 3-year low, and I think that'll obviously be a big surprise. In terms of a beat there, 0.9, it's not going to be above the maximum because the maximum is 0.9, but it will be above the prior, and I think that's good enough, and I'll explain why in a second. We quickly take a look at the labor cost. Expectations there is already for a big deceleration. The prior was 3.8. It's already expected to drop to 3.5. So in terms of a miss, I'll be looking for a number that's 3.3. Why? It's not below the minimum, but it's way below the prior already of 3.8. And if you take a look at the chart, let me just bring that up. If you take a look at the chart, anything below the prior is already going to be a new cycle low. So at 3.3, I think that'll be, ample surprise on the dovish side. And in terms of a hawkish print, 3.9, it's above the max. More importantly, it's above the prior at 3.8. Now, the caveat to keep in mind about this print, there's basically these 3 numbers, the unemployment rate, the labor cost, year over year and quarter over quarter. In the last 9 quarters that we've had data on this print, only one of these 3 had a deviation outside the forecast distribution, meaning a print below the low or a print above the max. Only one of them, that was the quarter over quarter number, out of the last 9 quarters. So it shows us that the markets aren't too bad at forecasting this, or it just means that the forecast distribution is always much bigger than what it should be. I'm probably siding with the latter on this one. Especially if you take a look at that huge minimum number on the job growth number. Interestingly, the job growth one, this one has a fairly good chance of surprising outside the market's forecast distribution because that one is about close to 55%. So 55, basically just over half of the last 9 quarterly prints, the job growth number printed either below the minimum or above the maximum. That's another reason why I'm okay with looking at these ones, fairly close to the market's maximum or minimums in terms of the surprise factor, because it's very rare for this data to surprise outside those ranges. Now, What we would expect in terms of the reactions for a dovish and a hawkish outcome. Obviously on the dovish one, we would expect Kiwi downside, yield downside. On the hawkish one, Kiwi upside, yield upside. But like I said, with positioning in mind, I'm not going to trade the Kiwi lower on a dovish outcome. I'll be focusing on a hawkish outcome. Now, there's three potential opportunities we can look at. Aussie Kiwi short, pound Kiwi short, or potentially Kiwi Swiss long. Let's start with the Kiwi Swiss long. That's one we've spoken about in recent couple of sessions. There, the opportunity is fairly simple. Massively stretched markets here. You know, if you take a look at this chart showing us the differentials, there is some skew to the upside there in terms of risk. Not massive, but we have more of these differentials are showing us upside risk than downside risk, right? I think that is that's good enough. And apart from that, if we take a look at this chart, which we've looked at many times as well, just a massive amount of volatility that's already priced in for the Aussie Swiss. Sorry, this should be the Kiwi Swiss. Where is the Kiwi Swiss? I've got it just somewhere. Where is the? Here we go. Sorry, no, that's not the one. That's not the one. Where's my Kiwi Swiss? Sorry, guys. Let me just quickly find that Kiwi Swiss one. Sorry, guys. Just give me a sec. Here we go. So, I mean, it's almost a carbon copy. Huge amount of volatility already priced in for this. This normally leads to mean reversion at some stage. It can't be sustained. You're going to see vols pushing lower, and if vols push lower, you expect the price to go up. So we already have differential suggesting upside. We've got obviously volatility suggesting some upside as well. What about the? So if we quickly take a look at the charts, you know, in terms of what to aim for, if it's a hot number, if we can get long this at fairly close to the recent bottom, just trading this back up to 51.70 could be worth it, right? So that'll be a key level to aim for to the upside based on this huge amount of downside that we've seen recently. Apart from that, Kiwi, pound Kiwi short, or potentially Aussie Kiwi short. Between the pound and the Aussie, you know, I would prefer the Aussie at this stage. Look, I like the pound lower. As you guys know, from a fundamental point of view, we are trading at some pretty interesting levels here. We've broken below that 216, if you will, psychological level. That was a key high going back all the way to August last year. So we are seeing a typical breakout retest continuation opportunity, which could open up a door back down towards that 213, maybe even if we crack below that, even lower. But obviously we need to watch what's happening to risk, right? Depending on how risk unwinds or deteriorates, pound Kiwi could be a little bit more complicated, because even though pound should be trading alongside them, it doesn't always trade that way. So you're not really protected, if that makes sense. You know, with the Kiwi Swiss, you have to hope for positive risk sentiment. But if you choose something like the Aussie Kiwi, you are isolated both on the commodity side, you're isolated on the risk side. It's just overall a slightly better option, I think. But if you take a quick look at the differentials, you know, they do suggest that there is more downside risk than upside risk for the pound Kiwi, but it's not aggressive levels. My preference then would be to, if it's a beat obviously, would be to trade the Aussie Kiwi lower. It's normally a pair that's just great from a differential point of view to trade anyway, you know, in terms of Aussie data, in terms of Kiwi data. We've got some really key levels to aim for to the downside, 109.30, then we've got that 108, 109.30, then 108.50, which is obviously the low. We're getting very close to the low from yesterday. If you take a look at the underlying market dynamics for this, differentials suggest downside risk for the pair in the aggregate. And there's also been just a huge blowout in terms of implied vol for this pair as well. So I like it lower for multiple reasons right now, and a big beat in that data could certainly give us a trigger that we're hoping for. Like I said, if it is a huge miss, we could see some downside. That would be the baseline expectation, but I wouldn't be excited about trading it. I would be looking for a beat to give me the higher probability opportunity.